We're here today with Roelf Groeneveld, Client Portfolio Manager of the Global Real Estate Fund. Roelf, welcome.
Yeah, hello.
2014 was a great year for real estate investors. Can you tell us more about that?
Yes, indeed. 2014 was a great year for real estate investments. And we always look at the returns in local currencies. And to give you some figures, we're talking about returns in 2014 of 20% plus, 22% for Europe, even 28% for the US. And the best country was Germany, which stood out with a return of 47% even. And but even taking into account currencies, dollar was strong, euro was weak. 12% stronger dollar versus euro. And then if you look for returns in euro terms, global real estate would end up with a yield return of even 30%. So a very strong year. And even in comparison to other asset classes, real estate was the best asset class last year, outperforming both global equity and euro bonds, which ended up at 90%, 11%. So a terrific performance for real estate.
Okay, and can you explain this ongoing success of real estate?
Yes, there is no one single explanation, but there are a couple. First of all, traditionally, real estate is driven by factors like economic growth and the labor market. Because when these factors improve, you immediately see it translated into better rents, higher prices, and for real estate. So that was certainly one driver of the market. And you also saw that back in the results of several real estate companies. Strong results, better than expected in the US, better than expected in Germany. A good example is Germany. When you look at the residential markets, we had many years with rents completely stalled. No change at all, below inflation. And now we gradually see rents improving, prices improving. And that also translated in some very good results. On top of that, in German residential, let's say the occupancy rates are traditionally very high, close to 99%. So you can imagine that some improvement immediately translates into better income. So strong results, and then finally also very important the monetary policy of the central banks, which was of course of a great help. If you compare European real estate, for example, with German 10-year bond yields, we saw the yields coming down from 2% to a level of 0.4, which is incredible, of course. And then if you compare that with dividend yields of real estate companies of around 3 or 4%, it's clear that drives investors to other opportunities, and real estate was certainly one of them. So yeah, that were the major explanations.
You just mentioned attractive dividend yields. Do we need to worry about the sustainability of these dividend yields going forward?
Yeah, dividend yields are very important for real estate investors. And traditionally, they consider the real estate dividends as a result of their long-term rental contracts. And therefore, you have a very solid, a stable, a predictable basis for your dividends. Yeah, and actually, because of the economic improvements that we have seen since the bottom of the crisis, actually we see that solidity even improving. Yeah, but that's not the same for other dividend stocks currently. And one example that I would like to mention is oil companies. And there you see something opposite. You see that oil prices have come down considerably, and they pay out a lot of their earnings in dividends. Yeah, so there you see the situation that investors get worried about the solidity of dividends. Yeah, so dividends of real estate are attractive, 3-4%, and particularly relatively compared to a lot of other investments, it's very appealing. And so we think that dividends are one driver, also going forward, a very important driver for real estate returns.
Speaking of going forward, do you expect this success to continue on to 2015?
If you look at 2015 and further, we think that key is the low interest rate environment. And we think that interest rates will stay low for longer, lower for longer. So that is to stay. At the same time, we think that the search for yield will continue. Those two drivers actually will also be there in 2015. Very important drivers for returns, in our view. And particularly, relatively speaking, to other investments, these are very important factors. And then, so finally, if you're talking about another factor which is a worry to a lot of investors, that's volatility in the market. And we all know that we are coming out of a crisis, that we are in a recovery. It's a slow recovery, it's a bumpy road. And so we will be confronted with some disappointments at certain points in time. So volatility in the markets is to stay there, and probably will not be lower this year than last year. So volatility will be there, but certainly in such an environment where we see a slow, steady recovery, we think that real estate investments remain attractive.
Okay, so we can expect a bumpy road but continued success.
Indeed.
Thank you very much, Roelf.
You're welcome.